Welcome to Range Trading Part 2, presented by DailyFX Education. In Video 1, we introduced the basic concepts of range trading. We explained how a currency pair is considered to be ranging when its price action remains contained within clear horizontal support and resistance lines. By remaining contained within support and resistance lines, range traders can more confidently identify entries and exits as they wait to buy near support and sell near resistance. We then explained how even the most well-defined ranges typically don't provide traders with a lot of trading opportunities right at support or at resistance. Instead, we recommended that traders use support and resistance zones to identify their entries and exits, as zones do allow for more trading opportunities. We recommended that traders divide a range into quartiles and suggested that traders buy in the bottom quartile and sell in the upper quartile. As expected, stops should be placed outside of the range. However, we pointed out that spillovers can occur, where price action temporarily breaks through a defined support or resistance line. If spillover had occurred, we recommended that stops be placed just beyond the most extreme spillover. And finally, we suggested the use of a 1-to-2 risk-to-reward ratio or better when placing these trades. In this video, we're going to go beyond the basics and provide you with a comprehensive look at range trading. We'll begin by discussing some best practices for identifying range-bound market environments. More specifically, we'll be talking about which pairs are likely the best to range trade. Every currency pair will likely range at some time. Even pairs that typically trend up or down strongly will find a time to slow down, take a breather, and begin to range. Finding the right pair at the right time is key to range trading, so we'll be starting our video off here. After identifying the right currency pairs to trade, we're going to discuss situations when ranges are most likely to set up and when ranges are prone to break out and start trending. And finally, we're going to conclude this video with an in-depth discussion of advanced trade management techniques. Proper money management is crucial to any trade, and we have 3 different techniques that we'll teach you in this video. Now let's get started with our first topic, locating the best pairs to trade for a range-bound strategy. Many traders consider interest rates to be the most important fundamental factor that determines the supply and demand of a particular currency, and we tend to agree. So let's talk about what role interest rates play in establishing good range-bound trading environments. In our Carry Trade video series, we discuss how money typically flows out of countries with relatively low interest rates and into countries with relatively high interest rates. This is simply a process where investors seek to earn the highest return on their investment. Wide interest rate differentials typically present market conditions suitable for trend trading. But what about when you have 2 currencies with similar interest rates and similar projected future rates? A similar interest rate outlook means there will be limited flows from one currency to the other. That essentially means the currency pair will experience a tighter trading range with all else being equal. Let's look at 3 examples to illustrate this point. You can see from this table that the Australian dollar, whose interest rate is 3.5%, has a large interest rate differential with both the Swiss franc and the Japanese yen, whose interest rates are 0.25% and 0.1% respectively. Due to the large interest rate differential between the Australian dollar and the Swiss franc, and the Australian dollar and the Japanese yen, money flows out of the franc and the yen and into the Australian dollar. Again, investors will typically seek the highest return on their investment. If we look at the Australian dollar Swiss franc and the Australian dollar Japanese yen daily charts, we can see how both pairs are trending up, showing how money is flowing into the Australian dollar. Now let's compare the Swiss franc and the Japanese yen, whose interest rates are relatively tight. By looking at the Swiss yen daily chart, we can see that the trading range is much tighter. A tighter trading range means prices are likely to bounce in between a defined support and resistance level. With neither country offering a significantly higher return on investment, investors do not have a strong reason to move heavily into either currency. Now to summarize, when locating currency pairs to range trade, First, look for currencies whose interest rates and interest rate outlooks are relatively close to one another. The smaller the interest rate differential, the more likely that the pair's price will move sideways. In addition to interest rate differentials, we recommend locating countries whose economies are closely linked. Since interest rate outlooks are dependent upon growth rates, among other things, pairing countries with similar growth prospects will also increase the likelihood of a range-bound market condition. Take, for example, Switzerland and the European Union. Generally, there is little difference between their respective growth rates. Also, their geographical location to one another makes them easy trading partners. As a result, this makes the Euro-Swiss one of the more popular range-bound currencies. If one country experiences growth or an economic slowdown, then the other is likely to follow. Similar arguments could be made for Europe and Great Britain, or the Euro-Pound pair, and also for Australia and New Zealand, or the Aussie-Kiwi pair. Their interest rate outlooks are generally in sync with one another, and their economies are very similar, making them good prospects to consider when range trading. Interest rate outlooks and growth prospects are great places to begin looking when deciding which currency pairs will be most suitable for range trading strategies, especially when looking to trade longer term, off a 4-hour or daily chart. Economic policy within a country does not change quickly. Think of a country as a big ocean liner. Unlike a racing boat, you can't quickly turn an ocean liner around to head in the opposite direction. Such a change happens slow and steadily. So too are the changes within a country's economy. Therefore, interest rates and growth prospects will typically hold for a long period of time, providing for many range trading opportunities. In addition to the macro conditions we just discussed, it's worth noting that range-bound price action can also appear at times when trading volume is reduced. For example, during off-business hours, like the overlap of the US session and the Asian session, trading typically does slow down significantly. Such a reduction in volume typically causes price action to stagnate, meaning ranging conditions can form. You may also find prices slow down during holiday sessions. As traders of the largest banks, which are the same banks who provide liquidity to the market, take off for the holidays, they leave behind them a skeleton crew to manage positions. With reduced staffing, heavy order flow will be very minimal, if any, at most of the major financial firms. Thus, price momentum will likely be contained to a defined range. Like the holidays, the hours leading up to news releases often cause the market to stagnate between support and resistance as well. This is because the large players are not willing to commit to new positions just before a news release, as there is so much uncertainty in the market at this time. Consequently, volume tends to be fairly light, making it difficult for prices to push through support and resistance levels. I've just summarized some of the most fundamental reasons why currency pairs will trade in a range. Now let's move on to discuss a few technical indicators that we can use to help identify range-bound trading environments. The three indicators that we will explore in this video are Bollinger Bands, ADX, and the average true range indicator. In addition to helping us locate range-bound environments, Bollinger Bands can also help us at times find our entries and exits. The ADX indicator and average true range indicator are good supporting tools, but they cannot actually help us fine-tune our entries and exits, as we'll see a little bit later. Let's begin with Bollinger Bands. The key to using Bollinger Bands in range trading is to look for the bands to be parallel to each other and running horizontally. It's really that simple. On this chart, you can see where the Bollinger Bands traversed horizontally. At this same time, you can see that price action traded sideways in a range. There's no magic to using Bollinger Bands to locate a range. Locating horizontal bands is similar to locating price action that's simply heading sideways, although sometimes it can be a bit easier to recognize a range with the use of Bollinger Bands. However, as we previously mentioned, Bollinger Bands can provide an additional benefit to range traders, as they can provide signals to enter and exit positions. Let's take a look. Here's a chart of the Swiss yen. You can see that price action is currently heading sideways, and the Bollinger Bands are also running parallel to each other. This is a great place to start. Now what we'll want to do is wait for prices to pierce the upper or lower Bollinger Band. Once this happens, we can enter a trade. You can see here that price action has pierced the upper Bollinger Band line, so we can take this as a signal to go short and sell into this range. If the band happens to be near the same price as a horizontal support or resistance level, like it is here, we can be even more confident in our trade. We recommend referring to our first video to determine where to set your stops and limits. Here's a situation where prices began to consolidate after a steep trend. After a strong trend, prices tend to consolidate and trade sideways for some time. However, at some point, typically the range will break and head in the direction of the previous trend. Using a combination of horizontal support and resistance and Bollinger Bands, we can strengthen our trade setup by filtering the trades we take, making sure to only take trades in the direction of the preceding trend. In this case, prices were moving down in the preceding trend, therefore we would only look for selling opportunities. First, let's draw a resistance line on this chart, and then we'll add the Bollinger Band. Notice how the Bollinger Band is forming right around the resistance line here. Because we're looking for short positions, expecting the downtrend to continue at some point, this looks like a good trade to take. Of course, we could have gone long around this area and this area, but we're trying to be conservative in our approach, as we knew that the market at some point would likely break down and continue in its preceding trend. A few weeks later, another situation evolves where the Bollinger Bands were horizontal and the upper band was near a resistance area, providing us with a few other short entry opportunities. To summarize this section, areas where you have a confluence of indicators, or said another way, when you have multiple indicators providing support or resistance in the same area, those opportunities tend to be stronger trades because of the strength needed to push prices through the confluence of support or resistance. In our case, we recognize that even though trends will slow down and range for some time, when the range breaks, it's typically in the direction of the preceding trend. Thus, we were looking for short positions. Additionally, our short positions were executed near resistance levels, when prices had pierced the Bollinger Band. The next two indicators that we're going to talk about play more of a supporting cast in range trading. These tools can help you identify range-bound markets. However, you'll want to revert to support and resistance levels, Bollinger Bands, or a combination of both when timing your entries and exits. Let's begin with the Average Directional Index, or ADX for short. The ADX was developed by J. Wellis Wilder in 1978 to gauge the strength of a trend. Since range-bound markets tend to consolidate after an established trend or result from trendless markets, we can use this indicator to guide us when the trend is very weak. Here's an example of the Euro-Swiss with the ADX plotted at the bottom of the chart. When ADX values are less than 25 or sloping downward, that indicates a weak or weakening trend. You can see how the circled areas below correspond to sideways movement in the price above. A range trader may add the ADX indicator to their chart and look for horizontal support and resistance levels when the ADX starts falling and moving below 25. When adding this indicator to your chart, most traders will use the standard input parameter of 14 periods. Here's another example where the ADX remained below the 25 figure. This time, we're looking at the Swiss yen. Notice how in each of these circles, as the ADX drops below and remains below 25, the price tends to move sideways in a range. Remember, the ADX indicator should not be used to determine an exact entry or exit price. This should be left to support and resistance lines or Bollinger Bands. However, the ADX can indicate when the trend is weak or weakening, providing you with a sign that conditions are ripe for a potential range trading opportunity. The second range trading support tool is the Average True Range, or ATR. In a range-bound market, prices tend to quietly move from one end of the range to another. This quiet movement can be realized in the ATR indicator. For example, when you see prices and the ATR trading in a narrow range, this indicates very low volatility in the prices. Most traders will add this indicator with an input value of 14. Specifically, we'll want to identify a potential range when the ATR begins to trade in a much narrower range than it has in the past. You can see from this chart where the ATR frequently ran up between 100 and 150 pips. Then for several months, the ATR found a narrow range between 50 and 100 pips. A trader noticing this could look to support and resistance levels on prices to enter range trading opportunities. Here's another situation on the Euro-CAD cross-pair. Notice how the ATR values begin to drop significantly and then consolidated sideways. After seeing this large drop in ATR values, a range trader could look for the prices of the currency pair to begin consolidating as well. Keeping an eye on the ATR values and making sure they continue to trade in a narrow range sideways tells us that the range-bound market conditions are likely to continue, at least in the short term. Now up to this point, we've identified what a range looks like, what pairs generally work well in ranges, and what tools are available to help us enter a trade. We're going to conclude this video with a detailed look at trade management. Each of the following techniques that we'll discuss involves scaling into a position, which is more of an advanced technique. The approaches that we'll cover in this video are developed solely for range-bound trading strategies. For most other trade management approaches, make sure to adhere to the guidelines we outline in our money management video series. One of the unique aspects to range trading is that this strategy minimizes the importance of timing your entries. Range traders are far less affected by the immediate movements in price and do not need to precisely time their entries in order to achieve profits. Let's contrast this approach with the directional or trend trader's approach. Take a look at this chart here. As a trend trader, the first step in preparing a trade is to establish a trend line to get a feel for where the support line is. After doing so, to achieve an optimal entry and possible outcome on the trade, a trend trader typically will try to enter as close to the trend line as possible. This allows for a much tighter stop and the potential for larger gains. In this example, a trend trader would most likely enter into a trade using the following methodology: long at 83.7 with a stop at 82.45 and a take profit at 86.2. This trend trader would use a single entry approach, trying to time the market in the hopes that the pair would move in his direction immediately, looking for the established long-term trend to continue. Because such an approach is a delicate balance between creating an optimal entry price versus not missing the trade entirely, the traditional directional trader would strive for a 2-to-1 risk-to-reward ratio so that he may be profitable even if he is accurate only 40% of the time. As you will recall in the first video, with range trading strategies we relied on entry zones and not on entry prices. Range traders therefore do not need perfect entries in order to succeed. In short, range trading is a much more forgiving strategy than the trend trading model that requires the trader to be accurate on both direction and timing, which can be quite difficult to achieve on a consistent basis. Additionally, with entry zones, there will be more entry opportunities and a few more money management techniques that we can employ. The three money management techniques that we're now going to talk about fall under the category of probative entry. This means that we're going to scale into our positions, or probe the market with multiple positions. All three strategies share similar characteristics, the primary difference being the trade size of each position entered. Here's a quick snapshot of the weightings on each strategy, assuming a total position size 120K. The entry prices for each strategy will be the same. The difference in the strategies is simply the trade sizes. Before going into the details of each approach and explaining the pros and cons to each approach, let's set the stage by laying a few simple guidelines that all three approaches will follow. The first guideline is to break the chart into quartiles. As you already know, we buy in the bottom quartile of a range and we sell in the upper quartile of a range. Our second guideline is to locate our entry prices. Starting with the first entry, you'll want to locate a price near the inside of the upper or lower quartile. Then, you should locate your third entry price, which will typically be near the outside of the upper or lower quartile. Now, to find your second entry price, you can simply add the first and third entry prices together and then divide by 2. And the final guideline is to determine your stop and limit distances. With these basic guidelines, let's move into some specific trading examples and see how each strategy works, and what the pros and cons to each are. The most common form of entry is called equal weighted entry, where each of your three entries are of equal size. In this example, you can see that we've broken down our chart into quartiles, and based on price action, we're going to look for some long entries in the bottom quartile. Our first entry price is going to be the low of this red candle near the top of the quartile. With this price point of 84.5, we can be fairly sure at least this order will trigger. The last price we wish to enter, nearest to our stop price, is 83.5. To find our second entry, we can add the first entry and the last entry prices together and divide by 2 to get our second entry price of 84. And finally, we can identify the stop price to be just below the spillover low at 82.45. We now have 3 entry prices and our stop price laid out. And with this strategy, once each of our entry orders triggers, we'll be entering trades of equal size. Since we advocate using at least a 1-to-2 risk-to-reward ratio, how do we accurately determine where to take profits? When using multiple entry points, it's best to find the blended average price of all your entries, so you have a single number to work with. This makes the process of calculating your stop distance simpler and more reliable, as you factor in all three prices and their weightings. In this situation, the average blended price, should all entry orders get triggered, would be the second entry of 84. The price was found by adding each entry price together and dividing by 3, which is the total number of entries we have. 84, which is what we came up with, is 155 pips away from our stop price of 82.45. So to achieve a 1-to-2 risk to reward ratio, we'll need to look to profit at least twice as much as our stop distance. So we look for a reward of 310 pips, or a target price of 87.1. Now let's discuss the pros and cons to this approach. One of the great advantages of this approach is that it allows us to establish at least a partial position in case the currency pair makes an early move back to the upside. Currency prices rarely cooperate exactly as we'd like. Sometimes prices turn before they reach the prior swing high or swing low, and at other times they can overshoot the price levels before turning. By taking partial positions as price action develops, we're able to capture at least some of the potential profit should the range trade setup begin to develop. Furthermore, by scaling into the position in equal size, we're able to achieve a reasonable blended average price for the whole position that's only slightly worse than a single entry near the prior swing low price level. The disadvantage of this approach is that we could essentially wind up adding to our losing position if the market makes a move against us. If the range pattern breaks by a downside breakout, we'd be stopped out with a greater loss than if we'd simply entered with a single entry at support or resistance, because the blended price of the position, or of all three positions, would be inferior to the single entry price right at support. However, the flexibility of this approach does exceed the small additional risk posed by the equal weighted scale. By providing a much greater margin for error to execute the range trading strategy, the equal weighted approach offers many more profit opportunities. An interesting variation to the equal weighted approach is the front weighted scale-in method that places a greater emphasis on establishing a majority of the position earlier in the move. Using the same range trading example as before, in the front weighted approach we would establish 50% of our total position at the first entry price, and then add 25% of the total position in each successive move. The entry prices would actually be the same, only the stop distance would be slightly different due to the average blended price, which is 84.125. Now the stop price wouldn't change, only the stop distance. Because a larger portion of our net position is opened earlier in the move, this means our average entry price is a bit higher than it was with the equal weighted entry. Thus our potential loss, if we get stopped out, will be a bit worse in dollar terms. So our target should be adjusted accordingly. With this strategy, we need to calculate our risk to reward ratio based on our first entry price of 84.5. We could have used the actual average blended price of 84.125, but I like to just use the first entry. By doing so, I don't actually have to calculate the average blended prices. I'm not a fan of pulling out the calculator if that can be avoided. The first entry price is just a bit worse than the average blended price. Also, I can look to pick up larger gains by using this first entry. The first entry price is 84.5, and our stop price is 82.45. That's a stop distance of 205 pips. Therefore, we should look for a profit potential of 410 pips, or a price target of 88.6. This actually gives us a slightly better than 1-to-2 risk to reward ratio, though we do have a wider stop. By being more aggressive at the beginning of the resistance zone, we stand a chance of earning bigger profits should the price action turn quickly, because we would be able to participate in the trade with a larger portion of our capital in the trade. On the flip side, however, the danger of the front-weighted approach is that it exposes us to more risk of loss by creating a worse blended average price. In the front-weighted entry, we'd be holding twice as many units at the higher entry price rather than at the lower scale-in prices. If you use this method, you should be quite confident that price action is more likely to turn sooner rather than later. For example, you might use this type of strategy right after a very significant piece of fundamental news is released, which you believe may turn price action sharply higher in the near future. The front-weighted approach would then enable you to enter a meaningful portion of the total position, but would still allow for further smaller entries if the market actually did retrace down even further. The final money management technique that we'll discuss in this video is the opposite of the front-weighted scale and entry. The back-weighted entry puts far more emphasis on the final portion of the position entered. With this approach, you attempt to achieve as favorable of an entry as possible, meaning an entry as close to the top or bottom of the range as possible while still taking advantage of the probative entry approach. As this chart illustrates, you only allocate 25% of your total position at the first two entries, and then add 50% to the final portion of the position. Again, the price entries and stop price will remain the same even in this approach. To calculate our profit target, we'll use the second entry from which to calculate our risk. The average blended price comes out to 83.875. But again, I like to alleviate using a calculator and prefer to push my profit targets a bit further when possible. So we'll simplify things by using our second entry price. In this case, our second entry is 84, and our stop is 82.45. That means we have a 155 pip risk, so we look for at least 310 pip reward. Our price target would be 87.1. When implemented successfully, the back-weighted strategy can be the most efficient probative approach to use in a range-bound market. By waiting until the most favorable price point to allocate the biggest amount of capital, we're able to achieve the fastest break-even point and the largest possibility for profit should price turn in our direction. Additionally, if prices continue to drop and take out our stop, the back-weighted approach produces the least amount of risk amongst the three probative trade entry methods, as most of the capital is allocated nearest to the stop price. Now, on the other hand, the back-weighted approach limits the potential profit of the range trade if prices turn quickly. In that case, you might only have 25% of your potential position in the trade, achieving far smaller profits. Nevertheless, despite its shortcomings, the back-weighted scale and approach shows the value of the probative entry approach, as it allows at least some exposure to a profitable range trade while minimizing your risk. This concludes our second video on range trading. We hope you found this video helpful, and we encourage you to attend a live webinar on range trading with our course instructors. In the webinar, instructors will relate what you've learned here to current market and trading conditions. Instructors will also field Q&A on the topic of range trading. Thanks for watching this video, and we look forward to seeing you in our live webinars.